Case number 14 is all about amalgamation of companies. Amalgamation. Okay. Here, company A, B, C, like a number of companies will be there, and one new company is formed, AB. This company takes over all the companies. All other companies are closed. This is one type, where one of the leading company will take over rest of the companies, and rest of the companies are closed. Only one existing company will continue after the amalgamation. Maybe this named as amalgamation, this may be named as absorption, but anyhow, for AS number 14 purpose, it will be considered as amalgamation only. Company A may be closed, and with a new image, they may start a fresh company where assets and liabilities of A company becomes assets and liabilities of A new company. This is called external reconstruction. All the three will be covered under AS number 14. Now, A and B, if A and B merged with the new company AB, after merger, A is also having rights in AB company. B is also having the equal rights based on their own share, where the business is collectively run, and these two parties will make the decision whether we'll run this or not. Whatever the decision may be, the shareholders of A will also be contributing and B will also be contributing to make the decision. Then in that case, this will be called as merger method of amalgamation company AB. After the formation, only A has a control, B loses its control. Then in this case, it will be called as purchase method. This is called purchase method. Is that okay? So understand that as per AS number 14, we have the amalgamation in two varieties, two forms. Okay. Method of amalgamation may be merger method and purchase method. Under merger method, after the merger, the transferor company will still have some rights over the transferee company. They will also join in decision making and all. Purchase method, once the purchase method is adapted, the transferor company no more will exist. Hereafter, the ruling party may be only the transferee company or some other party. That's called purchase method. Based on the method of amalgamation, accounting may also be different. Okay, in case of merger method, the accounting method may be pooling of interest method. So your interest and my interest just summed up. That's called pooling of interest method. Okay, both be joined together to run the show. In case of purchase method of amalgamation, we follow purchase method of accounting. Is that clear? So this is the simple thing you have to understand here. To decide whether it is being the purchase or merger method, we need to satisfy some of the conditions. Those conditions are listed here. 6 conditions are there. The method of accounting could be pooling of interest method. What are they? If company A, company B, where company B merged with company A, and for that the purchase consideration, the assets and liabilities are transferred. Number 1. Number 2, for that the consideration predominantly in the form of equity share capital. And the assets and liabilities of B company's assets and liabilities are going to be shown at book value at which it is shown. And you have to maintain the resource and surplus also. You have to retain this. And business should be continued. The B's company's business should be continued in the name of A or some new company's name. So B will be closed, right? Business is continued. So some dissatisfied shareholders will be there. For them, somehow it may be settled, and those shareholders may be sent out from this company shareholders. But provided the B company shareholders should be shareholders of A company at least 90%. Is that clear? So these are the conditions. One is transferors company's assets and liabilities will become assets and liabilities of the transferee company. 90% shareholders become transferee company's equity shareholders, and consideration settled by way of equity shares. For the assets and liabilities taken over, for that the payment should be by way of equity share capital. Transfer of business continue. Okay, the business should be continue. Okay, third one. This is third one, and business should be continued. Fourth one, and no adjustments to assets and liabilities means assets and liabilities should be shown at its own book value. And last one is retain all transferors, reserves, and surplus. Okay, these are the 6 points. Now we have 3 steps. The first step is all about calculation of purchase consideration. In the second step, you have to close the transferor company's books of accounts. Later on, in the books of the transferee company, pass journal entry and prepare balance sheet. So these are the 3 steps we need to follow here. Now, let's see. I'll give all the steps here once again in a brief manner. Step 1, you have to find out purchase consideration. Purchase consideration. Step 2, close the transferor company's books of accounts. Okay, close the books of accounts. Books of accounts of transferor company. Transferor company. And step 3, incorporate okay, the assets and liabilities taken over in the books of transferee company. In the books of transferee company. Transferee company. Clear? Purchase consideration could be calculated by way of lump sum method or net assets method or net payment method or intrinsic value method or share exchange value. Intrinsic value method, or otherwise it may be named as share exchange method. So we have 4 models here at interlevel. To close the books of accounts of the transferor company, you have to open realization account. This is a nominal account, like by selling all the assets and amount realized will be used for settling the liabilities. That's how you will close the realization account. And closing the realization account, you will get either profit or loss that may be adjusted in the equity shareholders account. For all the assets and liabilities are taken over by the purchasing company, so they have to pay us a lump sum consideration, which is called purchase consideration. So it is better to open the purchase consideration account. Thereafter, purchasing company account, who has to pay the due entry, last one being the equity share holders account. Even if it is needed, you can prepare preference shareholders accounts also, right? So these are the ledger account. Of course, purchase consideration account can be simplified by removing it. So 3 predominant ledger accounts to be prepared while closing the transfer company's books of accounts. One is realization account, next one is purchasing company account, last one is settlement to the equity shareholders account. In case of recording the assets or liabilities taken over by this company, okay, transferee company, they have to pass the first entry being business purchase account to the money payable will be in the hands of the liquidators of the transferor company. They will be responsible for distributing that to the various contributors. So liquidator of that company, liquidator of transferor company, okay, transferor company. And second entry being this business purchase consisted of various assets and liabilities. So I am renaming that to the various assets and liabilities. So assets account debit to liabilities account to business purchase. So if the value is not matching, if there is any balance either in the debit side or credit side, it may be named as profit or loss, but termed as capital reserve in case of profit, goodwill in the case of loss. Is that okay? If you are paying more than its worth, then it's a loss and named as goodwill. If you are paying lesser than the worth, then it's a gain named as capital reserve. And then make the payment to the liquidators of the transferor company, liquidator of transferor company. The payment may be either by way of equity share capital or by way of preference share capital or sometimes debenture or bank. Various mode of settlement will be there. So that will be credited here. And finally, you can prepare the balance sheet. You can prepare the balance sheet. Okay. Consolidated balance sheet may be prepared here. Now, what I have shown here in the third step, that second entry is for purchase method. If we go for pooling of interest method, means if the business is in the case of merger and we have to follow the pooling of interest method of accounting. In case of pooling of interest method, this entry is different. Rest will be same. Rest will be same. Here, assets account debit at what value? Book value, and to liabilities at book value, to business purchase, the whatever the amount we pay, and you have to show the reserves and surplus also. So what happens in case of profit or loss, sir? So if the company pays more than its worth, it's a loss. In case they pay less than its worth, what can we do? It's normally profit or loss. That profit or loss could be adjusted in the reserves and surplus. Why, sir? Because the existing company will be continuing as a decision maker in the new company also. So existing company also their company, new company also their company. So their loss in the existing company becomes the loss of that company. But in the earlier case, purchase, the transfer company no more exists. Only the transferee company exists. So they don't have any rights over that. So any profit or loss due to that absorption will not be considered as your normal profit and loss to be adjusted in your P&L account. So that will be named as goodwill or capital reserve. So this one only being the different. Here you will be showing at realizable value. Here you are showing this at book value. And even you have to maintain the reserves and surplus. You don't have the reserves and surplus here. Clear? So I have given all the formats here. You can see all these things here in detail. Clear? In the previous class I explained all these things in detail. So the entries are also be listed here. Now let's see. What are the practical problems you can expect? Sometimes you may be asked to calculate only purchase consideration, and we go for some basic problem for absorption. I'll solve the illustration under purchase method as well as merger method. Some basic problem for amalgamation. Absorption means company A, company B, where company A takes over company B. This is called absorption like. But as per AS number 14, both will be considered as variations of amalgamations only. Okay. And in case amalgamation, company A, company B, a new company A and B is formed. This newly formed company will take over these things. So company A also be closed, company B is also closed. So you know that in case of absorption, the sum pretty simple because you are going to calculate purchase consideration only for B, as well as you have to close the books of accounts of B only. But in case of amalgamation, you have to find out the purchase consideration for A as well as B, as well as you have to close the books of accounts of A and B. In case of advanced level, we may give at least we may be given at least 3 or 4 different companies merged into one company. Then what happens? You have to calculate the purchase consideration for all the 4 companies, and you have to close the books of accounts for all the 4 companies. Incorporate those assets and liabilities taken from all the 4 companies in the books of new company. So that's a lengthy process. Usually absorption seems to be pretty simple. Single illustration, like when it is being the amalgamation, you just repeat twice for each and every company. For A, what you do, the same you are going to do for the B also. Is that clear? And of course, we then move on to the comprehensive problem for absorption, comprehensive problem for amalgamation with some other adjustments. Okay, some variations like unrealized profit, intercompany owing, fractional shares. These are the cases you have to keep in your mind. So we'll try to finish up all the illustrations and then we'll go for a summary so that you'll understand all these things easily. Now let's see, come on. Calculation of purchase consideration is the question number 1. The balance sheet of SSA Limited and SBB Limited are given below. SSA Limited absorbs SBB Limited. So what happens? SSA takes SBB Limited. Thereafter, SBB will be closed to, so SBB being transferor and SSA being the transferee on the above balance sheet date. Calculate purchase consideration. State method of calculation of purchase consideration under the following alternatives. So what are the alternatives we have been given? Okay, number 1. SSA Limited takes over the business of SBB for rupees 3,000 and payment is made in the form of equity share capital. Then what is the purchase consideration? In this case, the purchase consideration being 3,000. What method of purchase consideration we follow here? Lump sum. We don't value each and every assets independently and find out the net assets. We simply calculate what is the value I am going to pay for this company. So SSA says, surrender all of your assets and liabilities to me and you close this. I'll pay you 3,000 rupees. That's all. This is called lump sum method of purchase consideration. Second one is SSA Limited takes over all the assets and liabilities at the book value, and then the consideration is paid in the form of equity share capital. Now, in the second model, we have not been given what? We have not been given the what method we have to calculate the purchase consideration. In this case, preferably you have to go for net assets. I have to value all the assets and liabilities independently. From the assets, subtract the liability. That's the value for the company. I'll pay that value by way of equity shares. That's the second one. So this will be net asset method. Net asset method. Is that clear? Let me calculate this one here. In case of second model, what model? Net asset method. Under net assets method, all the assets. What are the assets we have? Non-current assets, value being 3,000, and current assets, value being 2,000. Overall asset being 5,000 rupees. Only one liabilities we have, current liabilities 1,500. If I subtract the 1,500, the purchase consideration being, okay, from 5,000 you have to subtract 1,500, so 3,500 is the company's net worth. This will be the purchase consideration, and this will be settled by way of equity share capital of transferee company. SSA company's shares will be offered for that. Is that clear? So second one is net asset method. So first one is all about simply we calculate what model? Okay, lump sum method is adapted. So we followed only lump sum. The second case, the purchase consideration value is not given. If the value is not given, you just add up all the assets minus liabilities as per the realizable value. As the realizable value information is not available, we assume the assets, what they have in their book value will be the realizable value. Is that okay? That's how we'll understand. Third question, SSA Limited takes over business of SPB Limited and issue equity share capital of Rs 2,000, preference share capital 1,000 and cash 200 as purchase consideration. What about the scenario here in third case? Third case, I don't value your assets and liabilities independently. I just simply calculate what? I will offer you preference shares, equity shares, some part cash. Give me your business completely. I don't value your assets and liabilities independently. Instead of that, purchasing company offers various assets, various shares, various debentures and cash. Summation of that will be the purchase consideration. This method is called net payment method. Under net payment method, purchase consideration being equity share capital offered for Rs 2,000, preference share capital offered being 1,000 and cash offered being 200. So then the purchase consideration being 3,200. Is that clear? In fourth case, SSA Limited takes over the business of SPB Limited and issues equity share capital of Rs 2,000, preference shares 1,000 and balance in cash as purchase consideration. Come on, what method is this? In the case of fourth model. In case of fourth model, what is the method going to be adapted? So, purchasing company says, I will pay you 2,000 rupees equity shares and you issue preference shares worth Rs 1,000 and balance in cash. Come on. Can I calculate the purchase consideration by summing up all this value? Equity share capital 2,000, preference share capital Rs 1,000 and cash. Cash, how much cash is payable? I'm not sure. So under net payment method, what are the payments are made by the purchasing company? By summing up, if you are able to find out the purchase consideration, only then it is called net payment method. So we get the details of equity shares as well as preference share capital receivable from the purchasing company, but we are not aware about the cash. So we thought it may be net payment method, but using the net payment method, I cannot calculate. So it's not net payment method. Then automatically it goes for net asset method. Net asset method. So as per the net asset method, we found the purchase consideration being 3,500. The same 3,500 will come here. Okay. So it seems to be net payment method like, but it's not net payment method. How can you decide whether it's a net payment or net asset method? By calculating after the summing up of all the payment mode, if you are able to find out the purchase consideration clearly, then it's called payment method. Sometimes like this way, balance will be payable by way of debenture or cash, some other mode, then we have the confusion. What is that balance? You need to know the purchase consideration, the other model. Using the other model, you have to find out the purchase consideration. Only then you can close the books of accounts. Here, purchase consideration is 3,500. We found out that already using the net assets method, and cash balance is 500. This is balancing figure. So the fourth one is all about net asset method, not net payment method. And last one, fifth one. In fifth one, SSA Limited takes over the business of SPB Limited by issuing its shares at the intrinsic value. Intrinsic value is nothing but true value, which is nothing but share exchange ratio. For the share exchange ratio, you have to find out the net assets first of all. For purchasing company as well as selling company, for both you have to find out the net assets. So, fifth one, find out the net assets. So, we are going to follow intrinsic value method. Intrinsic value method. Intrinsic value. Okay. Here for SSA, you have to find out the intrinsic value per share. For SBB also, you have to find out the intrinsic value. What are the assets we have? Non-current assets, current assets. We have non-current assets being 7,000 and 3,000. In case of current assets, we have 3,000 and 2,000. Okay, the total assets being 10,000, 5,000, and current liabilities being 3,000 and 1,500. Then automatically net assets of company A as well as company SSA and SBB being 7,000 and 3,500. 3,500. Now tell me number of shares. Number of shares. 5,000 rupees per share being 10. It means we have 500 shares. And here 3,000 per share face value being 10, 300 shares. Now intrinsic value per share. You divide the 7,000 by 500. Hope it is 14 rupees. Am I right? Here 11.67. So 67. Okay. For every share of SSA having a value of 14 is going to be offered to SBB. Those shares valued at rupees 11.67. Then share exchange ratios, just reverse this. 11.67 shares will be offered. 11.67 shares of SSA will be offered for 14 shares of SBB. Okay. So SSA, I'll write it down here. SSA as well as SBB. Okay. So 11.67 shares of SSA will be offered for 14 shares of SBB. Why? If you multiply 14 and this one will be equal to 14 into this one. Naturally. So I have 100 rupees currency, my friend has 50 rupees currency. Then how will I exchange? Do it reverse manner. So 50 is to 100. Otherwise 1 is to 2 ratio. For every 2 currencies of you, I will pay you 1 currency. Because my currency is having 100 rupees denomination, your currency is having 50 rupees denomination. So after this exchange, you have 100 rupees currency of mine. Okay, I will have 50 rupees currency of you. So it will be matching. That's the logic here. Now, SBB has how many shares? 300 shares. For every 14 share, SSA will offer 11.67 shares, but SBB has 300 shares. Then how many shares of SSA will be offered for that? You can do the cross multiplication. 300 into 11.67 divided by 14. Come on, tell me. 250. Okay, we can round off this to 250 shares. 250 shares are going to be offered. Now, what is the purchase consideration in terms of value? In terms of value. Okay, in terms of value, very simple. In case of pooling of interest method, purchase consideration being 250 and per share costing rupees 10 face value. 2,500 will be the purchase consideration. Okay. In case of purchase, we have the other option. What is that? 250 share at rupees 10. So 2,500 is the purchase consideration. But assume that transferee company's share valued at 14 rupees. No. In excess of 4 rupees, you can treat this being the securities premium. Not necessary. Unless clearly stated in the question, go with this one. Or you can treat accordingly. The excess payment will be considered as securities premium. So 250 into 4 will be the securities premium. 250 into 4, 1000. The purchase consideration being 3500, which is equal to the net assets method. Like under pooling of interest method, we have to record all items at its own book value only. At its own book value. Is that clear? Hope now you'll be able to understand all the 4 models of purchase consideration calculation. Any doubts here? Come on, text me. Online students, come on, keep responding. I need to get the message from your side. Make it faster. Yeah. We'll start with first example, absorption. Prepare balance sheet after absorption under merger and purchase method. Okay. So you have to prepare the balance sheet directly. What happens here? We never bother about the purchase consideration. We never bother about the closure of the transferor company. We won't pass the 3 basic journal entries for incorporating. We need to prepare the balance sheet directly. So unless you will understand the complete structure I have given here, you cannot answer the requisite one. Okay, this entire structure you need to have. Here now, my intention is to prepare only the balance sheet. I don't prepare all these things. And even in purchase consideration, the value is given under lump sum method. So we have to directly go for preparing the balance sheet. Clear? Now, SSA Limited absorbed SBB Limited as on the above balance sheet date for a lump sum consideration of 2005. So SBB becomes a part of SSA. Though SBB merged with SSA, still SBB will have some control and participate in decision making also in case of pooling of interest method, merger. If SBB shareholders are losing their rights in the new company, then it will be considered as purchase method. Here, we have been asked to prepare the balance sheet, assuming this may be a merger method as well as purchase method. Both the way you have to solve this illustration. Is that clear? Now, under merger method, the sum is very simple. It's a line by line addition, pooling of interest. Pooling means summing up. Your interest and my interest are summed up, so both will have the interest over the running the business and will make the profit and share ourselves. That's the intention. So let me finish up pooling of interest method. First of all, assuming the purchase consideration being 2,500. Assuming purchase consideration being 2,500. Clear? You sum this one naturally. Okay, you sum this one. Only one thing is this equity shareholders will be offered 2,500. That's all. You can sum this. What happens? 5,000, 10,000, 4,500. Under pooling of interest method, reserves and surplus should also be added. 2,000 plus 500, 2,500. And 5,000 plus 2,500, 7,500. Because of this amalgamation, SSA gets profit or loss. SSA gets profit or loss. Come on, check. 2,500 rupees worth of shares of SSA is offered to 3,000 rupees worth of shares held by SBB shareholders. So you are offering lesser, right? As being a SSA owner, you are offering lesser. If you are offering lesser than their worth, you are really enjoying the profit. If there is any profit or loss, that will be adjusted in the ultimate resource and surplus. So this 500 will be adjusted here. So this becomes 3,000. This becomes 3,000. The amount what I have subtracted here is added here. Okay, 500 subtracted because I am paying less than their worth. If I am paying less than the worth, then my gain is now a part of my resource and surplus. Now simply tally this, you will get the value tallied here. Hope now you'll be able to understand 15,000, 15,000, it's merged. If the purchase consideration being rather than 2,500, if it is being 4,000, what happens? What happens in this scenario? Instead of 3,000 rupees, if I am paying 4,000 rupees, I am paying 1,000 excess. All the things are just pulled up, summed up. 3 plus 2, 5,000. 7 plus 3, 10,000. 3,000 plus 1,500, 4,500. There is no any problem here. Is that clear? Now, in case of equity share, already they have 4,000, 5,000 rupees. Equity shares are offered to the shareholders of SBB being 4,000. So now it is 9,000 rupees. The equity shares offered to the equity shareholders is excess by 1,000. If you are offering something excess, it's a loss for you. So that loss will be adjusted in the resource and surplus. 2,000 plus 500, 2,500 is the profit. From that, the 1,000 is subtracted. So then the ultimate value being 1,500. The ultimate value being 15,000. It's now merged. What we have found out here is net profit or loss after this amalgamation under merger method. The resource and surplus gets affected due to the excess payment and as well as the underpayment. Hope now you'll be able to understand this one. Okay, this one. If you are paying more or less, then this will be adjusted only in the resource and surplus. Clear? Now, this will be merger method. We'll go for the purchase method. If the purchase consideration being 2,500, record all the assets and liabilities at realizable value, and reserves and surplus are going to be scored out, and if there is any profit or loss, that will be named as goodwill or capital reserve. Under this one, you have to show all these things at the book value, and reserves and surplus will be maintained, and any profit or loss is adjusted in this account. That's a predominant thing. And there is no separate realizable value for assets and liabilities. We assume the book value is equal to realizable value. The book value is equal to realizable value. So the net assets being 7,000 plus 3,000, 10,000. This 10,000 is not equal to this 10,000 because this 10,000 is all about book value. This 10,000 is all about realizable value. As the realizable value information is not given in the question, we assume the book value is equal to the realizable value. Is that clear? Now, current assets 5,000 rupees and current liabilities being 4,500. Is that clear? Now, how much you are going to offer to the equity shareholders of that company, SBB? 2,500. So, 5,000 plus 2,500, 7,500. 7,500. Is that clear? Now, just to simply tally this. If you tally, do you get the balance in which side? Debit side or means asset side or liability side? You are getting the balance in the liability side, right? So 15,000, 15,000. So this may be 12,000. You get 3,000 rupees surplus here. This surplus is named as capital reserve. It's not reserves and surplus. Green color is for purchase method. So balancing figure, take all the assets and liabilities. Okay, all the assets and liabilities at realizable value. And for the equity share capital, what the amount you pay will be shown here. Okay, purchaser's equity share capital value plus the equity shares offered to the buyer, sorry, seller, club and post. If you tally, and the balance will be, if it is appearing the liability side, then it's capital. So if the balance appears the asset side, this will be goodwill. Is that clear? Hope now you'll be able to understand. If the purchase consideration rather than 2,500, if it is being 4,000, how this will appear? How this will appear? Assets simply added 10,000 and 15,000, 5,000, and liabilities 4,500, and equity share capital, SSA's equity share capital being 5,000 rupees, equity share offered to SBB being 4,000. Okay, so 5,000 plus 4,000, 9,000 is the value. Now finish up telling this. 15,000 and 1,300, 1,500, you get the balance. That balance is called capital reserve. These two are reserves and surplus. These two are capital reserve. Is that clear? Hope now you'll be able to understand the logics. You can understand the logic. Is that clear? If the purchase consideration is 6,000, what happens here? If the purchase consideration is 6,000, here it is clear, right? 2,500, 4,000, okay. If the purchase consideration being 6,000, how this will appear? Clear? Shall I go for that now? Yeah. Under this model, purchase consideration being 6,000, that too merger method. Merger method. You simply sum all these things: 10,000, 5,000, 4,500, and SSA is equity share capital and equity share offered to SBB. Equity shares offered to SBB being 6,000, so 5,000 plus 6,000, 11,000. Right. Now, what about the resource and surplus? 2,000 plus 500, 2,500. That will be the accumulated resource and surplus. But we are paying 6,000 rupees for the equity shareholders instead of 3,000. You are paying 3,000 excess. The excess payment to the equity shareholders being the loss that will be adjusted in the resource and surplus, but resource and surplus is only 2,500. There is no sufficient balance of resource and surplus. If you subtract the 3,000 from this 2,500, you will get 500 rupees negative. You show that as a negative value, resource and surplus. Show the value as a negative one. Now finish up telling this. Hope now the value being 15,000. The value being 15,000. Clear? Clear? Now what happens in case purchase method? Purchase method. Under purchase method, again add all these things at what value? Realizable value. Here being book value, and resource and surplus are maintained. Profit and loss on this will be adjusted here. This is what about the pooling of interest method. Under purchase method, realizable value, whatever the reserves and surplus we have is closed, and any profit and loss you get, will be transferable to the capital reserve or goodwill. Capital reserve or goodwill. Is that clear? Now 5,000 plus 6,000, 11,000. Current liabilities being 4,500, 10,000, 5,000. You know that you are paying 500 rupees excess. As you are paying 500 rupees excess because 3,000 worth, but you are paying 6,000, 3,000 rupees excess. Actually, 2,500 is already there. If you are setting off, still you have shortage 500. As you are paying excess, that 500 will be named as goodwill in the asset side. Okay, then the total being 15,500. Total being 15,500. Is that clear? This is a small difference between pooling of interest method as well as purchase method. Clear? Come on, make note of it. We'll move on to the next list. First two already available in Singar Academy text. So this one I have added a fresh one, like, okay. We'll go for the next illustration. If it is clear, text me. There you have goodwill, I think. Now assume here I have considered this one being the new company like. Though absorption, I consider this being the new one like. Okay. Rather than the new one, existing company maintains the books of account, how this will appear. We'll see that one now. Is that clear? I'll finish up this after this illustration. If it is clear, text me. We'll go for the next one and then I'll explain this one. Okay. The same company, what I explained here is all about assumed new company is formed. New company is formed. Rather than new company formation, make a small correction here. SSA, SBB. SSA continues, SBB totally closed. Okay. Actually, this is the correct absorption method. SBB closed completely, SSA is going to continue. Only this balance sheet items are going to be merged with SSA. This will be scored out, SSA remains intact. What happens in this scenario? What happens in this scenario? So earlier scenario, it's a formation of new company like exists, but here SSA is going to be continued. Okay. So as SSA is going to be continued, you are going to pass the journal entry only for closing SBB. SSA retains its assets and liabilities at its own book value. Only SBB's balance sheet items are totally changed under purchase method. Under purchase method. Here, absorption. It's a proper one. Absorption. Absorption. SSA absorbs SBB. In this case, SSA records its value as it is. There is no change. There is no change. Right. Clear? I am going to deal with absorption. I am going to deal with absorption. Where one of the existing company will continue. It's not going to be closed and formed a new one. SSA is continuing. SBB is closed. SBB is closed. In this case, if you follow merger method, okay, you take all the assets as it is. At what value? Book value. Assets and liabilities taken at book value. Reserves and surplus of the transferor company will be retained. And later on you can adjust the profit and loss. Later on you can adjust the profit and loss. Okay. In this account. This is all about absorption. One company exists, another company is going to be taken by this existing company. And current liabilities being 1500 and this value being 500 rupees. For 3000 rupees, the value of payment being 2500, right? So for this 3000, the payment is 2500. Is that clear? For the 3000 rupees, the value of payment being 2500. You are paying lesser by 500. Then this 500, lesser payment is also be a gain, also be added, so 1000 rupees. The new value being 7500, 3000, 4500. Is that clear? So the company which is going to exist thereafter just to retain all the assets and liabilities at its own book value, and the company which is going to be closed, for that all the assets and liabilities, reserves and surplus are taken at its own book value. Apart from that, what payment is made to the equity shareholders, that will be shown rather than the original book value of the equity share capital. Cross verify, are you paying excess or lesser? If you are paying lesser, it's a gain. That gain is added with this amount. If you are paying more, will be subtracted here. Is that clear? Hope now you'll be able to understand. Thereafter, do the addition comfortably. This method is called absorption like. Is that clear? I think it is tallying 15,000 rupees. This method is called absorption. Clear? Now, In case of purchase method, in case of purchase method, assets and liabilities are taken at realizable value, reserves and surplus not considered. Because of settlement to the equity shareholders, if we get any profit and loss, that will be transferable to the capital reserve or goodwill. Capital reserve or goodwill. Oh, okay, under purchase method. Is that clear? So what happens for SSA? I take all the assets and liabilities at its own original value, 5,000, 2,000 and 3,000. And here 7,000 and 3,000. Under purchase method, the transferee company's balance sheet item, will be taken at what value? At realizable value. As realizable value is not there, book value will be taken. Book value will be taken. The book value in this case being 3,000 and 2,000, and current liabilities being 1,500. What about the reserves and surplus here? Usually you will not consider the reserves and surplus. Is that clear? Right. Now, you are paying how much? 500 lesser. You are paying 500 lesser. 5,000 plus 2,500. 7,500. Reserves and surplus being 2,000. As you are paying 500 rupees lesser, clear? Lesser by 500, right? Yeah, okay. Now, total this first of all, 7,500. This being 2,000. This being 4,500. And this being 10,000. This being 5,000. Total of the asset side being 15,000. Total of the asset side, liability side should also be 15,000. Okay. So what happens now? There is a shortage 1,000 rupees in the credit side. If you get any balance in the credit side, that will be named as capital reserve. That will be named as capital reserve. Under which method? Purchase method. You have to consider only with respect to the transferee company. The transferee company's worth is 3,000 plus 500, 3,500 together with the resource and surplus, because resource and surplus will be clubbed with the owner's fund. Under which method? Absorption. One company continues, another company merged. One company continues, another company is merged. In this case, continuing company, already they have their profit, don't touch that. For the transfer company, what about their equity share capital? What is the accumulated profits and losses? Check that. 3,000 equity share capital, accumulated profit for them being 500, so 3,500 is the net worth. How much I am going to pay? Only 2,500. For the 3,500, I am paying 2,500, means I am saving 1,000 rupees. That saving is named as capital reserve under purchase method. So we have two accounts under purchase method. Here we have only one account. Okay. Merged and formed a new company is totally different. One company takes over the another company is totally different. Merged and formed a new company will be called as amalgamation type. But we don't have such classification as per AS number 14. But keep that in idea. Are you forming a new company or are you merging with the existing one of the big companies? If I am merging with one of the big companies, the company which is taking over not transferring company, their balance sheet remains same. Okay. For the transferred company, all the assets and liabilities are taken and merged with under at a realizable value. If you are getting any profit loss, that will always be named as capital reserve or goodwill. Under which method? Purchase method. Purchase method is totally different here. Clear? Okay. This one is given in Singar Academy's text. See this. This question number 2 is solved in our Singar Academy's text, assuming that absorption method is followed. Absorption means one company takes the another company. Okay. Amalgamation means both company closed and form new company. Like. Okay. I solved under this method in Singar Academy's text. Now, see, if the value being 4,000 under pooling method, we are going to have SSA continuing. Who is continuing? SSA continuing merger method. Okay, continuing means you have to take this company's value as it is 5,000, 2,000, 3,000, 7,000, 3,000. SBB is going to be closed. Then what we offer to SBB will be shown here. SBB. This is continuing. This is closed. So SSA is going to offer something to them. Under pooling of interest method, write all the assets and liabilities at book value. Okay, assets and liabilities are recorded at book value. Okay, and reserves and surplus maintain. Any profit and loss will be adjusted here. This is the format you have to follow. Okay, so record all the assets and liabilities at what value? Book value 3,000, 2,000, 1,500, and this 500 should also be. You have to maintain. You have to maintain. For 3,000 rupees, we are offering 2,500. So because of that, we saved 500 rupees. We saved 500 rupees. That 500 also be merged with this. You can merge with this. Is that clear? How do I get? Their profit being 500 already existing, because of offering lower equity share for their equity share capital, another gain is there 500, so 1,000. The 1,000 will be named as resource and surplus only. Resource and surplus only under which method? Pooling of interest method. Under pooling of interest method, we are maintaining all the things as it is. Now, after combination, SSA, after merger, you add up these two, 7,500, 3,000, 4,500, overall value being how much? 15,000. Here the value being 10,000. Here the value being 5,000. The value being 15,000. Clear? SSA. In case of purchase, what point you have to keep in your mind? Okay. Absorption. In absorption, keep SSA as it is. For SBB, you have to show assets and liabilities at realizable value. Reserves and surplus are closed. Because of this one, we get the profit and loss is named as capital reserve or goodwill. Capital reserve or goodwill. Is that clear? Remember this point. SSA values are 5,000, 2,000, 3,000, and 7,000 and 3,000. Their balance sheet remains as it is, because the shareholders of SSA will continue to be the shareholders. Any profits or losses for the SSA will be the profits or losses of equity shareholders of SSA. If it is being the profit and loss, the shareholders can demand to issue bonus share or dividend. Ask the board of directors to declare the bonus share. If I name this being the capital reserve or goodwill, they cannot ask. You understand? Because in the case of absorption, SSA is continuing. Whatever the existing profit and loss you know, automatically can be used for the distribution of the dividend to the existing shareholders. So it should not be named differently. But if you are taking the other company with you, that company is closed. Any profit and loss due to that is not a regular profit and loss for the distribution of profit and loss. That's why it is named differently, capital reserve or goodwill. You understand the reason? Sir, why do I want to confuse with the reserves and surplus and capital reserve and all? Sorry, all these things are profit. Yes, all these things are profit. In case of reserves and surplus, that can be used for the distribution of various benefits to the equity shareholders. If it is named as capital reserve and goodwill, it may be having some restriction, can be used rarely, probably if the company is supposed to be dissolved or liquidated or internal reconstruction. In those cases only you can use. Hope you will be now able to understand. Purchase, the other company is completely closed. Thereafter, the company's reserves and surplus is not matter for me. If the company merges with me, what happens? If the company merges with me, what happens then? Their shareholders will be continuing with me. their existing rights will also exist after the amalgamation. So only the resource and surplus will be named resource and surplus itself. As in pooling of interest method, the resource and surplus of the acquirer as well as acquiree, both the companies name resource and surplus named as resource and surplus even after the amalgamation means that they can use it for the distribution of the dividend. Is that clear? So now what happens under purchase method? SBB no more exists. Their profit will not be profit for the distribution. So it should be definitely named differently. Either it may be named as capital reserve or goodwill. Is that clear? So now what happens? 3,000 non-current assets of SBB and 2,000 for non-current assets of, current assets of is okay. SBB, and liabilities will be as it is. Okay. Oh, I have to rework out at 4,000, right? You didn't remember me. You didn't note, inform me, right? So I'll just stand corrected here. Okay. For 4,000 rupees. For 4,000 rupees. As I'm paying 4,000 rupees, their worth is 3,500, but I'm paying how much? 4,000 rupees. As I'm paying excess, 500 rupees loss. Whatever the profit and loss will be named as profit and loss only. So the ultimate value being 500 negative. Then final answer being 9,000. This will be 1,500. This will be 1,500. Sorry. Okay. Sorry. 1,500. Clear? Under purchase method, I am offering 4,000 rupees for the equity shareholders. Actually, their worth is only 3,500, but I am offering 4,000 rupees, 500 rupees excess. As I am offering 500 rupees excess payment, it's my loss. Can I adjust that loss in my resource and surplus? No. My resource and surplus can be used for distribution of dividend. This 500 rupees loss is a special one due to the acquisition of a company. Special loss will always be named as goodwill. This will be named as goodwill, intangible asset. Is that clear? Now, overall value being 9,000. Resource and surplus 2,000. This will be 4,500. Goodwill 500. Non-current assets 10,000. Current assets 5,000. Get me the total value. 15,500. Hope now you'll be able to understand the difference between the earlier model and this model. Clear? Clear? Let me give the summary. You can simply recap this one. What's the summary here? In case of amalgamation, okay, in case of absorption, okay, in case of amalgamation, company A, company B, and both the company are closed, right? Both the companies are closed. In case of absorption, company A, company B, where company A exists, these things are merged with. This is the absorption. Right. Under pooling of interest method and purchase method, as both the companies are closed, we don't have resource and surplus under this method. And under pooling of interest loss due to the operation, that profit and loss will be routed through this one. Under purchase method, if you have any profit and loss, that will be named as capital reserve or goodwill. In case of absorption, A's resource and surplus under purchase method or pooling of interest method remains as it is. That will be as it is because A is not closed. Their profit will continue even after the amalgamation. But B company is closed to, under pooling of interest method, you maintain this. Under purchase method, the reserve and surplus is closed. You understand? So when the reserves and surplus will be disappearing under purchase method, only if the company is closed, their company's reserves and surplus will not be existing. Clear? In case if I get the profit and loss, this profit and loss can be adjusted this account. Naturally can be adjustable in both the accounts. Under this method, profit and loss, if any, will be named as capital reserve or goodwill. Is that clear? Clear? Hope you will be now able to understand. So from this, it is very clear. This one remains same under both the model. Absorption or amalgamation, whatever it may be, remains same. But here there will be slight difference. The resource and surplus of the acquiring company remains intact. Acquiring company is intact. Clear? Hope now you'll be able to understand. Come on, make a note of it.